There's no moderator, I guess I'll start moderating it myself. David, why don't you give a quick introduction and a quick brief of what you do?
Yep. My name is David Park. I'm the founder of FinTech Automation. And just as a little bit of context, my background, I'm probably the oldest person that's going to be on this panel here today. Been in financial services for a little over 35 years now. And I started off trading derivatives in Wall Street for a firm called Dean Witter, if you remember that name, which is part of now Morgan Stanley. And then I moved to running a merchant banking fund for about 9 years. And then we started FinTech Automation about 7-8 years ago, predominantly as what's called an infrastructure as a service technology company. So as most of you know, FinTech stands for financial technology, where we bridge financial services and technology together to modernize what today seems to be a little bit of an antiquated system within financial services. And we started about 7 years ago. And for some of the folks that may not be quite as familiar from a FinTech standpoint, what that means when I say infrastructure as a service, I'm talking predominantly like if you're interfacing with some of you are doing on your phone today, and when you're going onto a bank app, that's a front end, right? So you're interfacing with checking your account balances, doing transactions, but that's predominantly all what's called a user interface. And if you ever kind of wonder where that data goes to, that data now travels to a infrastructure that is over 40 to 50 years old. And so the technology for that infrastructure really hasn't changed a whole lot. And so if you can imagine, you have this, brand new 2022 Ferrari, and it's running on a highway that's 55 years old with every bumps and cracks, and so you're going to get a tremendous amount of friction. So what we do is we modernize that rail, and we allow for less and less friction to happen between financial institutions, as well as even FinTech companies to help other banks modernize.
Wonderful. Quick intro about myself. So I'm CFO, CEO of Madison Park Group. Madison Park Group is a middle market investment bank. We're advisors to mid-sized, almost software companies in the tech ecosystem. The bank, we've been around since 2004. And we basically help founders, entrepreneurs, and sponsor-backed technology businesses achieve their transactional goals. I've started my career in finance in venture capital. Well, actually, before that, I started as a hedge fund quant. I wanted to be a quantitative person, but somehow I got steered into the venture world eventually. So I started my career in venture about 7 years ago, and I moved to investment banking over 3 years ago as a CFO of the firm, and we're very much focused into sort of being the best advisors on the streets, helping entrepreneurs and founders basically receive and act on on solid advisory. And this kind of ties to our topic, today, the roles of banks. And we were talking, David, earlier as to are we talking about retail banks here, capital providers? Are we talking about advisors? So I guess we can kind of encompass roles of every types of bank in this discussion, but that's what we do, and help founders, meet their goals.
So is Madison Park Group specifically looking at just advisory? Do you guys do lending? Do you work with lenders, traditional lenders, alternative lenders? Are you helping raise capital? What specifically for the audience would Madison Park Group be doing?
So at the moment, we're focused on advisory, M&A advisory, so sales, sell side, buy side, and capital raise. But definitely the progression towards, in the spirit of being able to help our clients from all angles and throughout the entire life cycle of their business, we definitely want to be introducing, capital lending piece down the road to continue adding value to our clients and to continue basically as a bank play a vital role in helping these companies kind of get to their objectives and get to their kind of growth milestones.
Yeah. So I have to ask a question because I saw the news coming out recently about Jobs Act 2.0 that allows smaller investors to invest in upstart companies that were specifically focused from an investor-based standpoint from institutions as well as high net worth individuals. So how does that change out, do you think, for the SMB or the SME marketplace?
Well, definitely that opens up the pool for a much larger investor base, younger, sort of a younger segment who don't necessarily, think the same way that more sophisticated investors believe in. We've seen the proliferation of basically SPACs and these kind of creative investment vehicles. So definitely the landscape is shifting with more young people investing, more kind of young capital sort of being put in businesses. I think that's crucial because not only the investors are coming in from that age group, but also you have founders and you have sort of business leaders today that are more skewed towards the younger side. So I think the investment ecosystem today, whether it's venture and whether any stage in venture or even late stage, it's not what it used to be before. The availability of capital is much more prominent today than it is before. Companies are able to raise money a lot more quickly than before. There's also, because of COVID, there's also a lot of a dry powder out there. There's a lot of companies eager to invest. I know entrepreneurs. I advise an entrepreneur, and he was able to raise money just with a pitch deck, with basically nothing else.
I think especially in the fintech world, we talk to a great deal of venture-backed firms as well as venture capitalists, and in almost every single case, there's so much competition for these startup companies. They're starting off at not even with an MVP, which is a minimally viable product, but just based upon a pitch deck, they're getting a $10 to $15 million valuation on an idea. And they're at 4 or 5 term sheets within the first week and a half. And so when you start talking about the ecosystem that's out there, I'm not even sure if my mic is actually on. I'm kind of holding on to this thing. Is it on?
It is, yeah.
Oh, okay. All right. What's very interesting is that when I first started in the financial services world, if you really think about, when companies actually go public, like if you take a look at Amazon would have never gone public that early if there was enough capital in the private market area. So if you take a look at when Amazon went public, it probably has done about almost 4,000% return, right? But in today's marketplace, companies will stay private until they become multiple billion-dollar valuation before they go public. So I think if Amazon was a startup in today's environment rather than 20-some years ago, I think they probably would have waited many years. And maybe the average investor that after it went public may be getting like 500 or 600% return, which is still a great return, but certainly not 4,000%. So as part of the Jobs Act and the ability for people to access these kind of startup companies, I think is going to be absolutely paramount. I think it's going to really change out the landscape of how SMBs really get money out into the marketplace through alternative lending. And we're seeing more and more of this. And as a fintech company ourselves, what we do is we have been helping banks modernize their rails, but we're also helping a great deal of fintech companies that are trying to get out into the marketplace. And what's really interesting is like 15 years ago, majority of the founders that we met with were engineering entrepreneurs. So they were able to engineer, create products, but over the last 5 or 6 years, they have been predominantly sales and product entrepreneurs. So they're more on the sales side, more on the entrepreneurial side from a marketing standpoint and a product standpoint. And because of that, we're seeing a great deal of people with specific domain experience, such as alternative lending. So we spoke with a couple of different partners where they are able to offer traditional lending products. So they would raise money from institutions, insurance companies, and start offering lending facilities, credit facilities to the SMB marketplace. That has been entirely an enormous void for, let's say, loans under $1 million, which have been traditionally in the SME marketplace. And the reason being is because a lot of the banks, they're really focused on larger, and so they are entirely focused on, let's say, $4 or $5 million, because it takes them just as much time and effort to give a $4 million loan than a $400,000 loan. And so they have a tendency to go much, much larger. So In the SME space, there's an entire void of capital, both on the venture side and on the lending side for that reason. And so one of the things that's very interesting is that a lot of the fintech companies that we're working with are trying to fill that void, doing everything from providing credit facilities, providing receivable factoring and things of that nature. So we're seeing more and more of these alternative lenders that are coming out of the marketplace. And that's one of the reasons why I was asking you that question, if you're actually working with a lot of these alternative lenders, but while you're doing the consulting side.
Yeah, no, I mean, that's interesting, and we are definitely interested in understanding how we can continue helping our clients with giving them access to capital, especially at the brink of transactions. But, we were talking earlier about automating some of these smaller loans, and I think, for small companies to be able to have access to that size of capital in a rather sort of expeditious timeline, I think it's what kind of puts us in the new era today compared to where we were before. But given your work, given what you do, Dave, how are you able to speed up, or what is how are you able to introduce technology to be able to help these banks kind of make loan decisions quickly? Because from my venture days, a lot of good sort of fintech companies, loan origination, end-to-end loan origination companies or end-to-end loan companies and aggregates or roll-ups, and we continue to see them fail or have very poor returns. What is also the distinguishing factor other than technology that you're helping these banks with?
So if you start taking a look at where I think banks fail to try to digitize, banks are traditionally, and I hate to say it because they're my clients, banks and CEOs of banks are not hired to be innovative, right? They're hired to keep the bank out of trouble. That's the whole part of the regulation aspect of it. And so because they're hired to keep the bank out of trouble, they have entirely compliance on their brain. So if you go to a digital account opening, you go online to fill out an application. Well, if it takes you 28 minutes to fill out that application, how many people do you think are going to actually drop out, right? So they have this kind of brain mentality of how to go about taking their traditional work into the digital world, but that's just not how people interact. So where a lot of these fintech companies have done a much better job is to try to create an Amazon-like experience of being able to create a better experience, finding a way to connect and understand the needs of that particular client base. And if simply they were looking at it from, the ability to onboard or get a lead online for that loan origination, and you take it in, 4-minute, 5-minute bites, no more, that process would go much, much faster. So a lot of these banks that have tried to modernize really kind of focus on doing it the same way as they were doing it in a paper format, and then what they're learning is they really need to create a much, much different user experience. So what we have done is to try to help them not only with that particular experience, but not every bank does everything. So people just think that every bank is exactly the same, but they're really not. There's, a dozen different types of charters out there. So some may do lending for small businesses, some may do, just mortgages and things of that nature. And so what we notice is that a lot of these fintech companies that come in and specialize in changing out the experience for the banks, and also in some cases they need a credit facility. And so because the fact that we're infrastructure, we have bank clients on one hand, we have fintech companies on the other hand, and this fintech company needs a credit facility. These banks want to lend money, but they just don't know necessarily how in an effective way. And this fintech company has been able to create a process by which it takes all the information, creates a great user experience, and then they do 80% of the work for the banks, and then they pass it on for the banks to do the last 20% on a manual basis. They make money, the bank makes money, and obviously the consumer out there that's looking for that particular loan is able to get a loan in a very effective and efficient manner, and that's kind of what's happening within the ecosystem that's out there. Mm-hmm. And so I think it's slowly but surely you're going to see that change kind of happen over the next 2 to 3 years, where I am noticing more and more banks partnering with fintech rather than trying to compete with it and vice versa. And I think that's really been, what's going to be creating, aside from the opportunity like the Job Act, to actually create a lot more capital for the SME marketplace.
I mean, in my industry, actually, is in the software industry, and I understand it's where SMEs are, we're comprised of multiple verticals, but in the software industry, banks or applying for a loan with a bank, or banks are always viewed as, an alternative, not an alternative source of capital, but tech companies prefer usually going to investors, going to venture capital and taking sort of seed money or Series A money or pre-seed money and what have you. I've always been curious actually to understand what could banks do to kind of keep adding value that at least matches or competes with what a VC sort of would bring in value. Because if you're taking seed or pre-seed money from venture capital, you're also getting a lot of support, right? We can debate on what each VC style or support style will be, but still a lot of companies, when they think about sources of capital, they're thinking about investors. What do you think, at least in this day and age, and with the way banks are also sophisticating the way they give out capital, what else do you think banks can do? Because that's a question that is top of our mind. What do you think banks can actually do to be able to add value as an investor or as close as possible?
Yeah, so let me maybe kind of recharacterize that question. What kind of value add can a bank or venture capital firm bring to a startup, right? There's a plethora of capital out there, so more and more venture capital firms are talking about, saying, hey, by the way, we're able to open up doors for you, we're able to do marketing for you, we're able to help you with the staffing and things of that nature. I am not sure right now they're doing the best job. There's a few firms I think out there that is doing a decent job of it. But I always kind of joke that the venture capital firms that are out there, they invest in technology firms, but they are the least technical people out there, right? They still do it basically in the back of a napkin. It's just really kind of a funny thing. And so to the extent that how they can actually fundamentally change, I think we're seeing more and more venture capital firms, especially in the technology space, if they're investing in it. Number one, the technology firms themselves, or the SME entrepreneurs out there, need help staffing.
Yep.
There is an absolute need to have more and more engineers out there to be able to build their particular product. And as I was saying earlier, there is less and less engineering entrepreneurs and more sales and product entrepreneurs. So those individuals are not technical people. They know the product. They know how to sell it, so they need support from somebody who's able to help build it, right? And that in itself is a major friction that I think the banks can help with. The other aspect of it is, if you think about what an entrepreneur really needs, aside from the technical aspect of it, depending upon, even if you're a sales entrepreneur, to be able to have somebody open up doors and say, here's, so-and-so, group that you talk to, or so-and-so company, to be able to give you access to a market. So when we actually work as an infrastructure company, because of the fact that we actually can get capital, working with, venture firms and banks and so forth, we have tons and tons of engineers, from a staffing standpoint. We actually help as part of our value-added service. We can actually help bring capital, through partnerships. We have access to tech engineers and product engineers. And to a large extent, we're working today with other venture capital firms to help reduce the risk of their investment. And we actually have been very, very focused on how do we bring value to that particular fintech company, not only bring the capital, but change out the entire J-curve. So when we start taking a look at specifically fintechs out there, if you really look at it, the entrepreneur and the technology they're building is almost identical. I mean, every literally month we may get 2 or 3 phone calls based upon somebody who wants to become, Brex, right? But the technology itself to become Brex is always very, very common. So we already have that on our platform, so we can actually help launch a Brex within months instead of years. And what we tell them is that when you raise a Series A or even a seed round, spend majority of that dollar specifically in marketing and sales, and not so much in the infrastructure. Now, once you get past a certain point and you want to own your entire tech stack, then that's different. But most startups will go from pre-seed to seed, and they're doing their best to get that Series A round that is so absolutely important. Right? And so we just tell them from speed to market and from, taking the capital and best use of that capital is probably not always building out their entire tech stack and just going after it.
Right.
Yeah.
Right. I mean, from what I'm gathering also, like, and given the current climates and given the current capital markets, I don't think there's shortage of capital. I don't think it's as difficult as it used to be to go and raise capital or to go and leave a good impression with a group of investors or a group of bankers. So, and just coming back to the topic of this discussion, the roles of banks into steering their growth, I think, if we kind of take a step ahead of providing capital, in terms of challenges today, and like you said, some of the technologies that these companies need to be building their platform are common or are democratized, or they need some level of innovation that is not as it used to be before. But what is and this is generally sort of a question. What, in my opinion, because staffing and being able to hire is as crucial as anything else, as crucial as being able to secure capital. Do you think banks would be able to help beyond providing capital? And I think that's a little bit ironic to say, because that's what banks are for, just capital, just a capital source. But we are here in the new era trying to innovate, trying to come up with new products, trying to come up with new ways to service our clients. So we would love to be able to help with everything. Obviously, that's not possible. How do you see value add beyond capital?
I've always said, if you were going to be a 21st century venture firm, you should be a tech-enabled venture firm.
Yeah.
I have continuously have said that over and over again, because there's, again, as you said, capital is not necessarily always a problem, right? But I think part of it is, aside from the staffing side, I think there's a little bit of mentorship that goes along with it, because we see, in my years of doing this, I've seen so much change in terms of even not only the types of entrepreneurs that are out there, but a lot of the, even crypto, right? Even alternative capital, it sounds like it's new, but if you really think about it, 20-some years ago, we had American Express traveler's checks. Yeah. I don't know if anybody in the audience remembers those traveler's checks. You're probably way too young. But at one point, they were such a large stable coin. They were probably the 25th or so largest circulated currency, even though it was not government backed. Well, that's basically crypto, right? If you really kind of think about it.
Fungible, yeah.
Yeah, it's a fungible asset. So at the end of the day, a lot of the things that have been digitized were already being done in a very, very non-digital format way back when. And so the way that I kind of see the marketplace, vastly changing, both from a bank perspective and from an entrepreneur perspective, the world is, including people through the metaverse, is digitizing. So we're moving from the information system age to a digitized age, which means that you're taking the information, and then now, because of the fact that we're moving to a digital age, it's not just the data that's so important, it's how that data moves that makes it so absolutely invaluable. Yeah. So from a banking perspective, if you're able to help someone be able to not only provide them capital, assist them with a certain amount of not only staffing, opening up doors, but teaching these, what I would call product and sales entrepreneurs, really the understanding of how data moves. Because how that data moves is going to be just as important, if not more, than the data itself.
I agree.
And which means that you, as a venture capitalist or as a bank, need to be able to digitize yourself and to kind of give them an idea how you take an older, what is a traditional financial services firm into the digital age. And I think more and more of that is going to slowly start happening. And I see that talking with various different venture firms, especially over in New York.
Exactly. I mean, we as a bank also, before we even expand to our clients, as a bank, we also have spent tremendous amount of money on digitizing ourselves, being able to do things faster through technology, being able to shave off analyst hours.
Yeah.
Um, and sort of try to automate as much as possible. But not only that, but there's also like a lot of IT push and lots of processes that follow that we do because we want to be faster, we want to be efficient, we want to be able to get to opportunities as quick as possible. So, you know, if digitization in a bank our size have taken this much effort, I can only imagine if you're actually a tech company or a middle-sized e-commerce company, the lift of that digitization. I think you hit the nail on the head there. We're moving towards digitization, the flow of data, because data is very siloed today. So you have your accounting data somewhere, you have your HR data lying somewhere, you have your CRM data lying somewhere. You have your performance, et cetera. If you're a trading firm, you have all sorts of. So how do you bring all of that together? How do you run analytics, and what are the people you hire to make that happen for you versus people you don't need to hire? Because again, digitization also implies a lot of help from technology, right, to automate things and to eliminate the need of having a human element behind.
Yeah, no, I think where I was going with the digitization, and I think you hit it right on the nose, is that if you make yourself as an investment bank, more and more effective, or venture firms, the traditional venture firms charge their LPs like 2% of management fee and 20% on the carry, like 2 and 20. I've run across smaller venture firms that are charging 2.5 to 30. Yeah. Venture, yeah. And so they get calls from their LPs every single day. When you're charging that high of a fee, you have to do a tremendous amount of work. So, basically, the whole idea of digitizing venture firms to me means like you can do everything, such as, let's pick on analysts, since that was one. They make you work 70, 80 hours a week. It's just ungodly job, right? You'll burn out within 18, 19 months. And all you're really doing is taking data and normalizing it, and you're spending hours and hours and hours, right? All that could be really pretty well digitized. And so if you can reduce the cost of what banks do, you may not have to charge nearly as much and still be just as profitable. And so that, to me, would mean there would be probably more LPs and more investors, which then will flow into the ecosystem out there, including for the reason I also mentioned the Jobs Act, is that the smaller investors are going to be pretty well protected, right? So if it allows, you can't charge those kind of fees. So I think you're going to find the ability for us to reduce fees. Like if you take a look at the mutual fund world, at one point they used to charge almost 2.5%, 3%, if you can imagine. Now ETFs will barely charge 10, 12, 40 basis points. So it becomes a kind of a capital raising effort to reduce that cost. And look at Vanguard. And I think that same ecosystem is going to change once the venture firms start to digitize, at least in my opinion, and hedge funds and some of the others. And then we'll attract more and more smaller investors and more capital out into the marketplace, alternative lending platforms out there. And all of that technology is very readily available. It's really somewhat perfunctory technology. It's just a matter of a will to actually incorporate that as in the form of the bank. And I think that's how it will also help out to the SMB marketplace out there, because eventually that'll feed more and more capital raise from a bank standpoint and then out to the marketplace. And that's what's happening with traditional banks.
It is.
Yeah.
I'm kind of curious how all of that ties to valuation climate, because I remember when I first started, venture valuations were extremely high. 2014 IPO frenzy, 2016 Q1 Q2 corrections came, and everybody was those phone calls kept coming in as like, what the hell is happening and why do we have so much markdowns, etc. And now things normalized again, and I feel like it's again going through motions and going through cycles. Banks definitely would be crucial into assessing their own valuation opinion, because it might be different than what an investor would think or what sort of the founder might think.
Yeah.
You do a lot of technical work in providing valuation or just the back end models. Do you believe that just the evolution of banks and the evolution of their services might have any kind of ripple effect to how these valuations are thought about? Because ultimately, it's like ultimately it's what it transacts at that is the,
Yeah.
that it is the value that is the true valuation.
So coming from a traditional asset management side, it's kind of hard to imagine, some of the valuation of these startups in particular, right? I mean, you're literally, going in and getting a $15 million valuation based upon the fact of a pitch deck. You're really, all they're doing is investing in the founders. Majority of them do not have an MVP out there, out into the marketplace, and some of the companies may have less than $1 million in revenues, yet they're getting a $500 million valuation, right? We know this through the wealth tech area, the other fintech areas. We see this over and over again, and it does seem a little unsustainable, but the idea of how you value something is really basically very, very traditional. So you can say, hey, we expect over a 3 to 5 year period of time for us to be making X number of dollars in revenue. We're going to discount that particular valuation to today's current valuation, right? That's a traditional valuation model. And so I think what's going to change dramatically over the next year or so as things start to normalize is that they're no longer going to take looking at a particular pitch deck and say, in 3 to 5 years, truly, how are you going to hit that number, right? How fictitious is this number? But the problem right now is that companies like Tiger Management and others are willing to pay so much for a valuation, it just lifts all boat at that point. Yeah. And so I'm not quite sure if that's fundamentally going to change, but I think over time, as more and more money comes in, including from smaller investors, I think all of that's going to very much normalize over time.
Yeah, I believe so too. And I think we're getting some cue for the time here. Do we have any questions from the audience at this point?
That good or that bad? One of the two. I'm not quite sure. I know this is the very, very end of the session.
It looks like we've locked it.
Locked it? Okay. All right. Okay. That's what we're going to believe. All right. Thank you so much.
Thank you.